Okay, we're live.
Good evening, traders. Welcome out to tonight's YouTube special webinar. It is Wednesday, June 24th. This is Coach Tyler Craig from Tackle Trading. Excited to be here. Have a wonderful session on the docket for tonight where we are going to be taking a look at how to break down a price chart. We've titled this video, The Art of Charting, partly because that's the exact title of a newsletter that serves as the motivation and source material for tonight's video and training. So I'm going to be borrowing from that and using a lot of the graphics and concepts that are in that newsletter. And essentially, here's what you're going to get out of tonight's discussion. If you're brand new into the world of trading and you need a template, a guide on how to read a price chart, how to read a stock chart and break it down from A to Z, you're going to find this immensely helpful. If you're a veteran trader and have maybe lost sight of the basics and lost sight of how to break a chart down simply, and just having a method to the madness, you know, maybe you've explored a lot of different indicators and you just feel like you're looking at too many things and you want to remove the clutter off the chart and focus on the nuts and bolts of what really matters. You're going to find this quite helpful. Essentially, I'm just going to show you how I walk through reading a stock chart from A to Z. And a lot of this, some of you may know, I'm a chartered market technician. Member of the Chartered Market Technician Association. And when I got that designation, I don't know, 7 years ago now, it does a really good job of helping you understand the right way to read a chart and the wrong way to read a chart. And so I'm drawing a lot on the educational side of how the CMT walks you through chart reading. So you could also consider this webinar, instead of the art of charting, how a CMT breaks down a price chart, you know, which you would hope that they do it properly. So you're kind of getting a sense of how a technician views price action, what are the core principles and such. So there's your intro. All right, there's your intro. I've got the disclaimer out of the way. I will be taking some notes here. And so feel free to use some screenshots if you want to borrow from the material. Nothing's really unique here. The benefit is the way in which we've organized the information and just the simplified template that you're going to get for how to break down a chart. All right. Okay, so many of you already are aware of this resource, but if you're not, I want to point your attention to a website, tradingjustice.com. Matt Justice and Tim Justice, which you all should know, they have a podcast. And one of the things that they do over there at Trading Justice every single month is they put out a free newsletter. They put a lot of resources and time behind that. It's free. And the reality is, if you put a lot of resources into a product that's free and nobody reads it, it just doesn't make any sense. All right. So I want to get the word out and make sure everybody is reading these. They're longer form kind of newsletters. So it takes a little bit more time to get through it, but it's packed with powerful content and enlightening topics. So for June, this was published in June on the 8th. The volume 32 newsletter was titled The Art of Charting. And I had the pleasure of putting that together. And so we're going to use that, right? So you go to the Trading Justice website, you go to the newsletter section at the top, you click on that, and you can actually see an archive of all of the prior newsletters, okay, going back months and months and months. But this month, we're focusing on technical analysis and charting. And let me take just 1 second here, and let me get, I'm gonna get the YouTube section up and make sure I can see everybody's comments. All right, there's Team Tackle. David, what's going on? Good to see you. Jimbo, hello, hello. CMT does have kind of a prescribed methodology for charting. I don't know that it's universal in the sense that every technician looks at a chart the exact same way. But if you and I were both trained in the field of surgery from the same school, we're probably going to go about preparing for surgery, engaging in the surgery in very similar ways, because we kind of subscribe to the same background and training and education and philosophy, right? And so I don't doubt you're going to see some variety among different traders, different CMTs, but by and large, they're going to abide by correct principles in the way they view things, right? And you're going to get a breakdown of that today. All right, so with that, let's rock and roll. Let's rock and roll here. So the first thing that the newsletter gets into is I draw a parallel between, has anybody ever seen the TV show Lie to Me? It's got it's a crime drama, and I'm actually going to look it up here. I used to love this show. I don't know why it went off. I don't know why it went off the air. I don't know how many seasons there were, but I love this guy, Tim Roth. He's a really good actor, and he's like Sherlock Holmes, right? Like, so he would be able to, I don't want him. I want the Lie to Me. There we go. He would be able to go into a situation where you and I wouldn't think anything was up, and he would be able to kind of read the expressions of a person. He could tell if they were lying. And for me, I wouldn't be able to tell, but he could tell, right? So he understands psychology, he understands people's behavior, and he is able to spot the crook very, very quickly because of his training, right? Because of his increased perception of what's going on. And I kind of think that's like charting and trading, where as a layman, you look at a price chart, you're like, I don't really understand what's going on. I don't really get it. I guess the market's bullish, sure, but I don't know exactly what I'm looking for. And so what I tried to do was say, okay, how can we bring our understanding of a chart closer and closer to this guy, right? Cal Lightman. And so that's where I'm going with the newsletter. Okay. So there's three basic principles that illustrate why charting matters, why technical analysis can be powerful. And if you buy into these three things, then you really start to grasp the power that is looking at a chart, analyzing trends, analyzing momentum and such. And quite frankly, if you think that chart reading is not useful and just kind of silly, then you would have to refute these three principles, right? So if you're going to try to attack technical analysis, you'd have to refute these three bullet points here. And so as you go through those, and I think through experience, through watching the markets, day to day, week to week, month to month, the wisdom of these three principles, the validity is made manifest, right? And so if you're a disbeliever in the use, the wisdom, the power of technical analysis, I think day by day, week by week, as you're actually paying attention, okay, the disbelief kind of goes away and you start to realize, hey, you know what? These principles make sense. They're grounded in logic and rational, thought. And so maybe there's something I can use in my own trading to improve my performance, right? To improve my performance. So first principle, price discounts everything. And here's what I'm going to do. I'm going to, let's put these side by side. I got a bigger screen. I think we've got room to do this. So 3 pillars of technical analysis, TA for short. Number 1, price discounts everything. Hello, Adib. Good to see you, buddy. Glad you're hanging out with us tonight. So price discounts everything. So when you look at a stock chart, you're effectively, if you're a pure technician, you don't really believe that you have to look at news. You don't really believe that you have to look at the balance sheet of a company. You don't have to be an expert in the business of whatever that company is doing, right? I don't have to know anything about technology and phones and computers to trade Apple, because as a technician, everything I need to know is revealed on the stock chart, okay? Anything that matters to Apple is going to be reflected in its chart, okay? And if it doesn't matter to Apple, it's not going to be reflected in the chart. And so when I'm looking at the stock chart of Apple, I truly believe I am simultaneously analyzing everything. I'm analyzing the fundamentals of Apple when I look at the chart. I'm analyzing the sentiment of the marketplace. I'm analyzing the political environment when I'm looking at Apple's chart. I'm analyzing economic data when I'm looking at Apple's price chart. It's all baked in there. It's all baked in there. If it matters to Apple, it's reflected in the chart. Okay, pretty quickly. Some would say instantaneously, all right? And so I'm not going to miss anything, in other words. I'm not really going to miss much because I'm viewing everything through the lens of price, okay? So price discounts everything. That's why we think it's so powerful to follow. Number two, price trends, okay? It's not utterly random. It's not utterly random. And so we believe that there is the tendency of prices to continue in a certain direction, up or down, okay? And so one of the parallels I draw here in the newsletter is if you subscribe to what's been called random walk theory, you basically say that, look, the stock market's, like in its pure form, you would say the stock market's completely random. And it's like trying to guess the next direction or the direction of the next step of somebody who's drunk and is just stumbling all over the place. Is he going to jump left? Is he going to go right? You just don't know. It's completely random, right? But if you believe in technical analysis, if you believe in this principle, you kind of believe that there are cues in the way the guy's walking that make it easier to guess which way he's going to go, right? To bring some sense of order, some sense of predictability to the price chart, okay? So you think there's a little bit of an edge by looking at charts and that prices aren't utterly random, okay? And so there's all sorts of phrases you hear that essentially reinforce this idea. A trend in motion stays in motion. So if a stock's in an uptrend, I'm going to give it the benefit of the doubt it keeps going, right? Same thing with the downtrend. Number three, history repeats itself. History repeats itself. So think about that. I like the phrase past is prologue. Past is prologue, which I believe is a William Shakespeare phrase. So look, a technician believes that there's a lot of value found in studying the history of a price chart, okay? And that is because even though everything in the world changes, everything about the markets can change, technology, the stocks that you're dealing with, the different companies, even though all that changes, at the end of the day, it's people that are buying and selling stocks. It's humans. And human behavior is, when you look at group behavior, it's quite predictable, okay? And so if you go yell fire in a crowded theater, you can predict the response of all of these people collectively pretty consistently, right? Pretty consistently. Now, individuals predicting the behavior of one person is quite challenging because people are weird, people are crazy, they're unique, they have idiosyncrasies. But when you're talking about group behavior, when you're talking about crowd behavior, you know, humans are relatively predictable. They respond to fear, they respond to greed. They did that hundreds of years ago and they do it today. And so that is why when you look at a chart, what you'll see is patterns repeat, patterns repeat. If you didn't believe that, like if you didn't believe that history rhymes, that there is some regularity in the way that asset prices behave over time, then it would be pretty hard to make the case that you should go look at a 1-year chart. You should go look at what a stock did a year ago. You should look at these patterns because they wouldn't repeat. You couldn't expect that. You couldn't have confidence in that. But the reality is they do. You will see patterns crop up again and again and again. When you go back and you look at some of the original technical analysis books, like by Edwards and McGee, they were written, like 100 years ago. And it's like, well, isn't the market different today than it was in 1920 and 1930 and 1940? Yeah, it is different. But what's not different is humans. And collectively, they do the same things again and again and again, right? All right. So you could say the response to isn't this time different is yes. And to add, it's always different, right? The dynamics, the news of the day, pandemic, crisis, whatever it is, sure, you can have a new crisis every time come down the pike and say, well, this has never happened before. True. But the response of market participants to that news, the response of market participants to that, recession or pandemic or whatever, could play out in a similar fashion to how it did in the past. So if you want to get better at understanding how the markets top and how the markets bottom, we think there's value in going and studying tops and bottoms in the past, right? Okay, so those are the three pillars, okay? And by the way, you might say, well, this is a lovely little lesson on theory, but what I want to do is I want to go actually look at a chart and you show me some hands-on how-to stuff. Well, we will. I will definitely do that. But the reality is, if you can spend a few minutes on the theory and really understand it and believe in it and develop confidence in what the core principles are, it makes you more invested when you do the how-to. It gives you greater confidence as to why maybe it will work, okay? So I don't just want to tell you what to do. I'd like to tell you why we're doing it. And that's kind of how I'm organizing this, as we're starting with the why, and we'll get incrementally more and more into the what, okay? All right, so hierarchy of charting. Okay, let's take a look at this. The way that one of the things that I like about writing is, and I talked to Tim about this the other day in the halftime report, is just trying to come up with new ways of explaining something, just a new spin, a new angle, just to keep it fresh and exciting and interesting, particularly if you have to write about the same stuff again and again and again, right? And so the angle for the newsletter was, look, charting has become relatively complicated over time because they keep creating new stuff. They keep creating new things. When you go look at a charting platform and you go look at the studies, right? You go look at the studies and you say, I want to add a study, or which is another word for an indicator, or just go to edit. And you look at this, it's like, man, did you know there was a time where none of these indicators existed, right? Maybe one of them, right? Maybe two of them. And this isn't even, I don't think, a comprehensive list. Like, there's more and more and more. People like to tinker. They like to come up with new ways of slicing and dicing the data. Maybe it's partly because they want to have something named after them, right? I get it. I got an ego too. I think it'd be cool to have your own unique indicator. But it really muddies the waters with how much information there is. So part of my objective was to cut through the clutter, okay, and give you a hierarchy. So here's what I said. To aid you in your chart reading quest, here is a hierarchy you can follow. Okay, consider it a pecking order that helps you move chronologically through a price chart. Okay, and I listed them in order of importance. And so the first item is going to be the most important. Okay, and that trumps. If the fourth thing we look at is bearish, but the first thing we looked at was bullish, I'm still going to lean bullish. Okay. What you'll discover, though, is the best trading setups and the best opportunities usually have things line up kind of in harmony, right? So if everything is bullish, I can be more confident than if half the signals are bullish and half are bearish. Okay. So here's the hierarchy. Okay, you got 5. Now, I probably could have made this longer, but you know, I don't want to have a 55-point checklist. All right, I want to be able to move through this with speed and again, just focus on what matters. Okay, just focus on what matters. Okay, now some of you are saying it's a little bit blurry. Did we find a workaround with that? Moose Lady's given us a good suggestion here on the quality. Maybe changing up your quality. You could also try a different web browser as well. Okay, and I just tried it. So I changed the quality on my YouTube video on the bottom right. And I increased the quality and it is crystal clear for me. Yeah, it's in the YouTube settings. So thanks for the assist there, Moose Lady. Okay, and it did work. Perfect, perfect. Okay, so let's talk about price trend and momentum first. Price trend and momentum. Okay, and again, I'm going to use the graphics in the newsletter to guide us. Okay, the first one is pretty simple. I suspect that you're all relatively familiar with what an uptrend is or what a downtrend is. Okay, so here's an example. This is actually the NASDAQ, the recent uptrend in the NASDAQ. You can see right here on the right. And what I've done is I've labeled the peaks, sometimes called the pivots or the swings. So these are the swing highs, the peaks are the pivot highs. Notice how they're progressively getting higher. So the consensus for the value of this stock is rising. Demand is increasing. Every time this stock sells off, buyers emerge quicker to buy each dip. Okay. So the definition of an uptrend is higher pivot highs and higher pivot lows. The definition of a downtrend is the opposite. Okay, this is a picture of Simon Property Group, a real estate ETF, not ETF, sorry, a REIT, real estate investment trust. Okay, these guys own a bunch of commercial properties. You can see, and this was recent, wasn't too long ago, you can see a downtrend, right? The consensus for the value of the stock is getting lower. Sellers are emerging quicker on each and every rally. So like this time, sellers didn't take over till SPG went up to 168. And then the next time it rallied, sellers took control around 165 and then 164 and then 155. They're getting more aggressive, right? Supply is increasing. That's the nature of a downtrend. Okay, so when you look at the market right now, okay, I'm going to pull up in a chart of the NASDAQ. Can we all agree that the NASDAQ is in an uptrend? If we look, and really what I would do to get good at this is I would take everything else off the chart. You guys want to get good at reading trends? Take off all the crutches. Just look at naked price action. All right? Just in all its glitter and glory. And what you'll discover is that you start to get more comfortable and more familiar with identifying these pivots, these swing highs and swing lows. Okay? So the NASDAQ is in an uptrend. There's no doubt about it. Okay. Where it gets a little bit dicey sometimes is when you're transitioning, right? When you're transitioning. Today, for example, market got smacked today. First significant down day in a bit. And so how many after a day like today think, I wonder if that's it. I wonder if this is the beginning of a bigger downturn. Was that the top? I swear, every time I see a decent down day and an uptrend, in the back of my mind, I'm like, maybe that was the top. I can't avoid it. I cannot avoid it. I'm like, you know what? Maybe this was a false breakout. We're screwed. This was the top. I knew the NASDAQ was overheated. You know, it's screwed. Maybe, but really you don't have enough evidence yet. It's premature to call this thing dead. Okay. You know, so even though maybe you can't feel the heartbeat, it's there, and you need more confirmation that this trend is rolling over. I'll tell you one that's not as crystal clear though. How about IWM? Okay, this was in an uptrend, higher high, higher high, higher high, higher high, higher high. You look at the pivot low, higher pivot low. Now this made a lower pivot low technically here. Okay, came back up, and I'm going to call this a higher pivot low. Now, would this right here, let me edit the color. Did we have a lower pivot high? Did we have a lower pivot high here in IWM? Maybe. Looks like a lower pivot high to me. Is that a change in character? Yeah, I mean, if I look at these other pivots, they were up, 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 and now we have a potential lower pivot high. Okay. Do we have a lower pivot low yet? No, actually not yet. I mean, if you're calling this 133 the prior pivot, you haven't yet made a lower pivot low. So we can definitely say that small caps are showing more weakness than tech. All right, but is it in a full-fledged downtrend? Not yet. Okay, what's progressed a little bit further than this is energy. XLE got smoked today. Energy was in an uptrend. Boom, 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 boom. I see higher pivot highs all the way up this thing. But what about right here? What about right here? I guess blue is going to be my bear color. I think this made a lower pivot high. Move this a little bit. Energy made a lower high, didn't it? XLE. What a piece of junk. And you know what? If you were talking to me yesterday, I would have said, you know, yes, it made a lower high, but it's not dead yet. Didn't make a lower low yet. Because if I look at the pivot lows, I see swing low, higher swing low, higher swing low. Okay, had a couple of equal swing lows here, higher, higher. Guess what happened today? What a hunk of junk. Okay, this guy, you let me, there you go. This guy, let's go left and blue. I'll even go large, add some emphasis here. Technically, we made a lower low on energy today. This might be one of the first sectors that is now in a downtrend. Okay. So let me ask you a question. Do I need to go read about the fundamentals behind energy companies and their debt and where they break even with regards to oil prices? Do I need to look at the weekly oil inventories? I could spend a week, like literally 10 hours a day, learning everything I need to know about Exxon and Chevron and some of these energy companies and oil and the political environment and how much oil Russia's putting out and Middle East. I could spend forever doing that. But you know what? I think it's simpler for me to just look at this chart of XLE and say, look, it don't look good right now. I don't want to be buying energy stocks here. Okay. Last month, different story, but I just saw a lower pivot high and a lower pivot low crop up on XLE. Okay. And it looks not great. Okay. You square with trend, pivot highs, pivot lows. That's the first piece. Are they getting higher? Are they getting lower? The relationship between the last couple of pivots will tell you more than just about anything else on the chart. It's the most important. Now, the next piece that adds a little bit more insight on the pivots and trend is the momentum, right? So if trend, think of a moving train, okay? Trend tells you is the train going northbound or southbound. Momentum tells you if it's speeding up or slowing down. Is it speeding up or is it slowing down? And the definition of momentum is it's the distance between the pivots. Are the pivots getting closer together? Are they getting further apart? And it's easiest to just see it. How about this trend? This is zoom. Zoom, look at this, look at the resistance levels, look at the distance between the pivots. Small move, big move. This one broke resistance and ran, I don't know, 10 bucks. This one broke resistance and ran 30 bucks. Right? So you've got a increase in momentum. I love to find uptrending stocks that are increasing in momentum. Those are the best stocks to buy on a pullback because they've got a lot of gas in the tank. In contrast, this is what it looks like when the trend is slowing in momentum. You can see a big move after breaking out, and then it breaks out and makes a really small move. It's decreasing momentum. I would much rather buy a pullback in Zoom. If this were to come back 3 bars, I'd much rather buy that dip than to buy this one. So what I would write in the chat window there is we don't buy dips in an uptrend that's decreasing in momentum. That's a long sentence, okay? So how about just decreasing momentum? I'll type it here. Decreasing momentum equals don't buy the dip, okay? If we're increasing in momentum, I want to buy the dip. That's a good trend. I want to buy the dip. That's a good trend. Okay. Now, if you look, Amit, I won't really be sharing the document, but as I shared at the beginning, if you go to the newsletter that was published this month at Trading Justice, it effectively has a much more comprehensive overview than my notes would be. Okay, I'm essentially copy pasting from this newsletter and it's free. So I would grab that. So what I did in preparation, just right before we started tonight, is I went to my watch list and I said, let me flag the stocks that have increasing momentum. These are the ones that I'm interested in buying on a dip. Okay, and so I just sorted my watch list by price, highest to lowest. Do you know the first one on there that has increasing momentum is Amazon? If you look at the distance, now I'm going to go to my little box here. Okay, so here we have a pivot, and then we broke out, moved a little bit, then we broke out, moved a decent amount. And if you look at the last swing, I don't know if it was increasing in momentum as much as it was just maintaining momentum. Okay. But I like the acceleration in Amazon. So if this thing were to carve out, 2, 3, 4 bar pullback, that's the type of dip I like because the trend is increasing in strength. This northbound train is speeding up. And that gives me more confidence that buyers will step up and buy the dip. Another one that has a similar look is Shopify. I would say this trend is increasing in momentum. I really like how far it ran after breaking out. I like the strength of this rally. Okay, and so if this thing comes back multiple bars, that would be a pretty textbook bull retracement pattern. How about Adobe? Is that increasing in momentum? Yeah. Look at the distance between the pivots on the last, in particular, it's the last 3. Here's your pivot high, boom. Here's your pivot high. Prior to that, you were here. So look, it broke 390 and ran to 410, ran 20 bucks. And then it broke 410 and ran to 446. It ran 36 bucks. It ran 20 and then it ran 36. Okay. And it looks like you're getting closer and closer to the top of a mountain is what it is. Like the rate of ascent is, do you see how it's getting steeper? Right? That's an indication that you're increasing in momentum. Slowing momentum would be the inverse of that. It's, it's rolling over at the top. Zoom, increasing in momentum. Zoom's just ridiculous, just nutso. Okay, again, one of the strongest stocks in the market, zipping higher, and on a pullback, I'm interested. Apple, same thing. Spotify, this one's ridiculous. Increasing momentum. Okay, so I like this on a dip. All right, so that's the first piece, trend and momentum. I got to look at that first, guys. That is the very first thing I would identify before I look at anything else. Okay, all else equal, we'd rather buy the increasing momentum uptrend. Okay, and you can flip that upside down when you're looking to go short. All right, what's next? Support and resistance. Support and resistance. Okay, so I know, so this is my increasing momentum list. I got Adobe in there. VIPS is one I'm actually going to show you here in a second. You know, Apple, Amazon, Zoom, Spotify, like those are the ones increasing in momentum on this last advance. Now, support and resistance. These are the floors and ceilings. I'm going to briefly go through this one because I could spend a lot of time on it. But look at the pictures here, okay? The definition of trend, uptrend, higher pivot highs, higher pivot lows. Momentum, the distance between the pivot highs is expanding in an uptrend. Move a little, move a lot. Definition of support is an upward move in price. So type down, down, up. Down, down, up. That is support. That's it. Okay. Some people say down, down. We're at support. Well, you don't know yet. You don't have that upward move in price, right? Upward move in price. That is the definition. Down, down, up. You got to have the up move to signal that buyers are swooping in. Demand is overcoming supply. Okay. Support is like a floor. Why do we care about support and resistance? Well, look, here's an easy way to think about it. You got a 50-50 chance, 50-50 odds up or down on a stock. Okay, I would call those your baseline odds. So when your stock's at support, I don't know, we don't really know what the exact number is, but conceptually, how about 55% chance up, 45% chance down? So what does it do when the stock is at support? It just gives us a clue. It just kind of tips us off that, hey, we're sitting at a floor here. Maybe the stock's more likely to go up than down at this point. Okay. Or if I'm at a ceiling, a resistance level, instead of it being a coin flip, could the stock go up or down? I'm actually leaning a little bit more bearish. So maybe 45% chance we continue higher, 55% chance we go lower because we're at resistance. Okay. And then my asterisk would be unless you break out. If you break support or resistance, then you actually bet on continuation. Like if I break a support level, then I actually think it's more likely to continue lower. If you haven't yet broke support, you know, I'm bullish. Okay. So when you look here, my favorite three areas or three kind of things to look for as support on a chart are prior pivots, areas of congestion, and unfilled gaps. Prior pivots, areas of congestion, and unfilled gaps. And so when I look at this chart, okay, this is ES, look at how I drew these lines. The stock is at 30.85. And as I look to the left of that, the first area of congestion or pivots that I come across are a cluster of pivot highs. You break those pivot highs, then you have some pivot lows right here. Got another pivot low there. You break those, you got a cluster of pivot highs right here. I'm just drawing lines at the pivots, guys. Just drawing lines at these turning points. That is my map for where potential support is going forward. So you take a look at any one of these that we talked about having increasing momentum, where I'm interested in buying on a dip. You say, okay, where's support and resistance? Okay, where's support and resistance? Well, let's start with Spotify. This was essentially one fluid move higher. I know you have a couple of red and then green bars, but by and large, this was one advance. So if we start to sell off, where's my first either A, unfilled gap, B, prior pivot, or C, area of congestion? Well, technically, you have an unfilled gap right here. See how this jumped up right there? That's an unfilled gap. That could be a potential support level. Okay. That one's a little bit less significant, so I'm going to ignore that in this instance. After that, you have pivot high. That to me would be a potential support level. Because another principle that's discussed in the newsletter is known as the principle of polarity. Now, you guys know this as old support becomes new resistance, right? Here's an example. An old floor becomes a new ceiling, right? The floor, so I have a basement in my house and I have a second level, right? So the floor of my first level is the ceiling of my basement, okay? The ceiling of my first level is the floor of my second level. Floors and ceilings, ceilings and floors. You know, they can essentially morph from one to the next. So I see Spotify had old resistance here. If this thing pulls back, now I don't know if it'll pull all the way back here. Like I would be surprised if it dropped that much. I think it'll form a new higher support level, but if it keeps going down, to me, that's the first reference point. It gives you a sense of how far Spotify has come off of support. If you break that, I see another series of pivots right here. That's another potential support level. You break that, and I see a whole bunch of pivots that topped out right around here. Resistance, 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 resistance could become new support. You break that, you got a little pivot here. You break that, you've got another pair of pivots here. You break that, you got a swing low here. You break that, and you got a bunch here. Now, support at 115 is not relevant right now because the stock's at 242. This is just an exercise to give us a sense of where these levels are. But really all I care about is where's the next support level? Where's the next resistance level? And I just use the pivots. Now, notice I don't have moving averages. I don't have anything else cluttering up the screen, just a naked candlestick chart so that I can focus on the pivots and the price action, you know, what really matters. So am I going to buy Spotify here? Well, no, because even though it's in a super strong uptrend and has really good increasing momentum, the risk reward is not great. Another reason why we really like to key in on support and resistance is because that's where you have good risk reward setups, low risk, high potential reward, some asymmetry. That's what we want. We want to look for situations where if we're wrong, we lose a little. And if we're right, we make a lot. And you will discover that those spots on the chart correspond with key support and resistance levels, right? That's what we're going for. All right, let's see if there's anything else. I think I'll leave it at that. You've got areas on resistance as well. You got some graphics there, but resistance is just the inverse. It's a downward move in price. Resistance would be up, up, down. Okay, up, up, down is going to be resistance. All right, so I've identified the trend and whether it's increasing or decreasing in momentum. I've identified support and resistance. Now I go into moving averages. So moving averages are really the first indicator that I would look at. These are the first indicators that I would look at. And if you followed us at Tackle Trading for any length of time, you know that all the coaches use moving averages to one degree or another, okay? And one of the easiest ways to use a moving average is just as a proxy for what the trend is. It smooths everything out. See, as I was identifying some of these candles, some of the pivots, sometimes it's messy, the relationship between those pivots, right? Like you know, when I was looking at the NASDAQ, it was pretty clear. Like those pivots were getting higher, right, progressively. But sometimes you get like in between a trend and you get some lower swing highs as well, or lower swing lows, you know, mixed in there. And it just gets messy. The relationship between the pivots can get messy. So the moving averages can smooth everything out. The moving averages can smooth everything out and make your life easier. So with the moving averages, there's all sorts of different lengths, but essentially 20 MA is going to give you a good indication of the short-term trend. The 50-day moving average is going to give you a good indication of the intermediate term trend. And then the 200-day moving average is a good indication of the long-term trend. And different traders will use different time frames, but in general, these are the three that I'm going to teach you. And so when I overlay that on top of the chart, now I have some lines added in here, and it gets a little busier, but it helps to clarify what I was seeing on the pivots. as well as things that maybe I wasn't picking up on. Okay, for example, you may not have known what the long-term trend was just by looking at the last 6 months. But now that I put that 200 MA on there and I see that the 200 MA is flat, that tells me the long-term trend of small caps is neutral. Okay. When I look at the NASDAQ just over the last six months or 3 months, I know the short-term trend was up. I didn't really know the long-term trend was up, but now that I have the 200 MA on there, that helps me to know that the long-term trend is also up. Okay. So if the pivots get messy, or even if they're not messy, and you want a nice, easy line to tell you bull or bear, MAs will do it for you. Okay. So this is the bullish posture. This is the most bullish posture you can get. NASDAQ's going to be our poster child. Rising 20 MA, rising 50 MA, rising 200 MA. I have a trend alignment across all time frames. Buyers are dominating the short term. Buyers are dominating the intermediate term. Buyers are dominating the long term. They have complete and utter control of the NASDAQ right now. That could change tomorrow. Actually, it won't change tomorrow because it takes time for these moving averages to roll over. But for now, trend in motion stays in motion. I'm giving it the benefit of the doubt. Okay. What would concern me is if you saw the NASDAQ start to look more like IWM. IWM is below its 200-day moving average. It's below its 20-day moving average. Okay. And so it's starting to show signs of weakness. It's not as strong. Not as strong. When the moving averages, and on my chart, these are simple moving averages. EMAs are similar. They're a little more sensitive. But when a moving average crosses another, it can be a bullish or a bearish signal, and so usually it confirms what you already knew. But like if you look right here, you can see that my 20-day moving average, the red line crossed above the blue, that's a bullish cross. Okay. So when you get a bullish cross, it's sometimes referred to as a golden cross. And the one that people anchor on is the 50 and the 200. When the 50 crosses above the 200, it's a golden cross. And then when you get a downward cross where the short-term crosses the long-term, it's done as a death cross. Okay, so like the 50 breaking below the 200. But remember, they're lagging indicators. So if you use the pivots, that's going to give you the quickest indication of if the trend is turning up or down. The moving averages will follow. Right? Like the NASDAQ had already gone from $96 up to 136. NASDAQ went up like $40 and then the 20 crossed above the 50. Well, you saw the change in pivots well before you saw the crossover in the MA. Okay. But that was bullish. It was bullish when the 20 crossed above the 50. Okay. So if I go back and I look at some of these other charts like Adobe, I say, hey, Adobe's in an uptrend, increasing in momentum. It's above all its moving averages, super bullish, right? It found resistance yesterday. I'm looking for it to pull back down towards support. Old resistance was 411. Maybe that could be the next support level. Okay. What do I look at next? After I've identified what my moving averages say, and this is obviously a brief run through here. And you can see on the chart in the newsletter, I use the NASDAQ. Right? And the nice thing with using multiple moving averages is you get a sense of what the short-term and long-term looks like. Okay, so I give you a couple examples of that. The next indicator I look at is volume. The next indicator I look at is volume. Now, I could talk about volume for an hour. I'm going to give you the short version. I really like I don't know. I need to go back to English class. Sometimes I say something's a metaphor and it's probably a simile. Sometimes I say it's an analogy and it's probably a metaphor. In my head, see, I'm a simpleton. I get similes and metaphors and analogies mixed up all the time. Okay. So I may misuse those terms, but I don't care. I'm comparing things. That's what I'm doing. So I really like comparing volume to punctuation. Okay. I think volume provides punctuation. And so if you think about what punctuation adds to a sentence, it adds emphasis. And specifically, like what punctuation am I talking about? How about an exclamation point? When you add an exclamation point to a sentence, you know, if it was a period, it would read that chart is bullish, period. If it was an exclamation point, it would read that chart is bullish. Urgency, excitement, emphasis. When you get an update on normal volume, it reads the stock went up today. When you get an update on really high volume, it reads, wow, oh wow, the stock rallied a lot today. Like there's more urgency, emphasis, it's more significant. Why is it more significant? Why does a high volume day have more gravitas than a low volume day? Because of what it implies. There are two types, if we were to be overly simplistic, two types of traders. There are retail traders like you and me, where we're swinging a $10,000 portfolio, a $100,000 portfolio, $1 million portfolio. And then there are institutions which are swinging billion-dollar portfolios and have big money. And they move the market, not you and I, by and large. And when you look at volume, that kind of tells you who's participating. High volume days suggest the big boys are moving money. Normal volume, low volume, you know, big boys aren't doing as much, or at least it's not as urgent. So high volume up days indicate institutions are coming in, they're buying, they're accumulating shares. High volume down days suggest that they're distributing shares. And so in the newsletter, you'll see me show examples of these exclamation points, these high volume bars. They have a little bit more significance. Okay, they have a little bit more significance. So you take a look at a day like today. You say, well, what do I think about a day like today? When I look at the S&P 500, I am already a little bit concerned because it put in a lower pivot high. I'm already a little bit, well, actually, it wasn't yesterday. One of the things that concerns me today is we broke below the 20-day moving average. We broke an MA. Now, look at how the volume adds a little bit more concern, caution to the recent price action. I see a bunch of high volume down days. High volume down day. Okay. High volume down day. High volume down day. Well, those are called distribution days. Okay. And you'll notice, by the way, that prior to we're in June 11th, prior to June 11th, we didn't have a lot of high volume down days. Like from here to here, this whole like 2-month spurt, you really didn't have much distribution at all. And that's great, right? Not a whole lot of, aggressive selling going on, but all of a sudden June comes in and for whatever reason, you're starting to get a cluster of distribution days in the S&P 500. Okay. Warning signs. Maybe they won't amount to much. Maybe tomorrow we go right back up and everything's okay. But in the meantime, a little bit concerned, a little bit cautious, particularly after today's sucker punch. You look at XLE, the energy sector. We already know the pivot formation has changed. We've broken the 20, we've broken the 50. Today had some nasty volume on it. Distribution day. Institutions were not accumulating energy. They were distributing energy shares. They were bailing. That's volume. Punctuation adds the significance to the sentence, the urgency. Don't read too much into volume, guys. If it's normal, it's just a period. Okay. If it's low, it's just a period. It's the high volume days. It's the exclamation points that pique my interest. Number 5, final one is candlesticks. Actually, I guess it's second to last. Candlesticks. Now, quite frankly, I got to this point in the article and I'm like, we're pretty, I don't know what I was, 2,500, 3,000 words in. I'm like, I'm not gonna write a book on candlesticks at this point. So because candlesticks came last, I didn't write as long about it because it was just getting long in the tooth. Okay. But there have been books and books and books written on candlesticks. This is the reason this is number 5, guys, is it's super short term, right? It's super short term. It's just what really happened today or yesterday. Like what significance does that add to the chart? Was it a reversal candle? Was it a really bullish candle? Was it a really bearish candle? That's like really short term, sets the tone for me the next day. Like I didn't like today's candle. It was ugly. Okay, especially in XLE. That's an ugly candle. So the pivots already were warning me off. The moving averages are warning me off a little bit. The momentum was warning me to be a little cautious in energy. The volume was warning me today. And I don't like the candle. Pretty nasty candlestick. You know, so I see a bunch of yellow lights in XLE. Any other indicator is last. All right. Let me ask you this. At this point, don't you think I've pretty much made up my mind? Don't you think I got a pretty good handle on what's going on in this stock chart, whether it's close to a buy point or not, close to a sell point? Do you really think I need to go number 6, number 7, number 8, number 9? Like, do I need to go look at 13 other things? Probably not. I think my decision's by and large made up, but I did give some indicators their due. I said, look, if you want to look at the stochastic, the MACD, the RSI, the on-balance volume, or one of the other hundreds, feel free. Feel free. All I'm saying is significance-wise, importance-wise, you know, what trumps. Indicators are not going to change my mind, okay? Like I am not going to, so we'll use energy again. There's no really indicator is going to trump or cause me to change my cautious tune after looking at the weight of all prior 5 pieces of evidence. Evidences. I don't know if evidences is plural of evidence. I think it's just evidence. I don't know. But you know, it doesn't really matter what the RSI says. So for me, it's like, look, if it's not going to change my mind, why bother? So quite frankly, I'm usually done at this point. Okay. So then what you'll discover is that when you have this hierarchy, in whether you write it down on a piece of paper, whether it's in your head, as I go through a price chart from A to Z, 1, 2, 3, 4, 5, like that's kind of chronologically how I'm going through the chart. It's in my head, so I just kind of do this. I've looked at a gajillion charts, so I do it subconsciously, but that's kind of my pecking order. And so at the end of the newsletter, I said, let's tie this all together. And I gave a couple examples. So the first case study we did was Spotify. And I broke down the 5 or 6 pieces. Okay. And what you'll notice is chart patterns are a combination of these. Like when somebody says a bull retracement, a swing buy setup, a buy the dip, those are all 3 the same thing, by the way. In my mind, what do I see? When somebody says, hey, that's a bull retracement, in my mind, going through my hierarchy, I say, oh, so it's an uptrend increasing in momentum. It's pulled back to support on average volume. It's probably above its 250 20-day moving average. Ideally, it's got a nice little bullish reversal candle. That's what you mean when you say bull retracement. So packed in that 2-word phrase, if 2 words can be a phrase, bull retracement is a lot of information, right? I know it means uptrend increasing in momentum, pullback to support, above the moving averages, light volume on the pullback, bullish reversal candlestick. That would be the ideal bull retracement set. It's just a heck of a lot easier, more succinct to say bull retracement than to list all 6 characteristics. So Spotify had a bull retracement pattern. Number 1, it had an uptrend increasing in momentum. Look at the pivots. Number 2, after finding resistance, it pulled back multiple bars towards a support level. Number 3, it's above all its moving averages, confirming that bulls control all time frames, the trend on all time frames. Number 4, you had really good volume during the rally, confirming the strength of the uptrend, and then you didn't have much volume by comparison on the pullback. And number 5, you had a couple of bullish reversal candles. So together, all of those point towards this being a good setup. And we now know what happened since. So I go back to that chart of Spotify. I say, this is when it was on there. This is when I flagged it for the newsletter. Thought it was a good example. What did it do since then? Well, it went up and then sideways. and then sideways, and then finally went nuts to the upside. Now, I don't know if you would have stayed in the whole time, but in hindsight, if I say, yeah, this right here is when we flagged it as a potential bull retracement, we'll fetch. It's up like $100 since then, right? So, it was a good read. It was a good read. Okay. The last one was a bear example. So I kind of flipped it upside down and showed what a bear example would be to go through those, 4 or 5 indicators or 4 or 5 pieces. Okay. So how do you feel? Do you think we missed anything major? Do you feel like this hierarchy checks maybe not every single box, but the significant boxes? I feel like if I look at each one of these on a chart, the chart in question, then I'm going to have a pretty good sense of whether I want to buy it or sell it at the end. Okay. And so when I look at VIPs was another one I threw on there. So I say, okay, what do I think about this chart? Well, again, when you throw up a chart to somebody who's brand new, it's like, I don't know, where should my eyes go? Like I feel like I'm at a carnival and there's carnival barkers just barking for my attention. And I don't know where, I don't know what tent to go to. There's bells and whistles and, I'm like torn. Where do I go? Where do I go? Well, you just need a guide. You need somebody to come and hold your hand and help you avoid the games that are rigged and just take you to the good ones, right? Well, this is my guide. This is what holds my hand and helps focus my attention on what matters. So I say VIPs, lovely uptrend, increasing in momentum. It just found resistance. It's pulling back towards support. It's above all its moving averages. Volume pattern looks great. Look, the market had a big distribution day today. VIPs didn't. Volume on today's down day was average. And so we didn't have any excessive distribution. I would like this to have another couple of down bars, but at this point, I like the setup. It didn't take long. It took me 20 seconds and I just ran through the hierarchy, right? So you can massage this. It's not meant to be comprehensive or perfect for everybody. You can add in your own, indicators and such. But I've done this a lot. I've taught this particular little template to tons of traders. And I don't know that I've ever had somebody say, there's a massive gaping hole in there, you bozo. You're missing X. I've never had somebody say that because, quite frankly, we're not missing nothing. You could tack on other indicators, but by and large, you have analyzed a price chart from A to Z, and you got a pretty good idea what's going on at this stage, right? Okay. So let me end with this. Number one, JT, welcome aboard. I mean, if I was a nice guy, I would just redo the whole thing right now. But I don't know. Not the nicest. I'm a meanie every once in a while. We were going to wait for you, JT. Like, guys, JT's not here. Let's wait. But then I'm like, got to be nice to everybody else. We recorded it. We hit the record button. So yes, it will be uploaded 100%. And like I said, if you think, boy, give me a write-up of everything you just said tonight. Well, I already did that. I preempted this with a write-up. That's what the newsletter was for. Okay, so if you have not yet signed up to get these newsletters, they're free. I don't know why you wouldn't. If you want to be enlightened and entertained, go sign up for it. Right? Tradingjustice.com, go to the newsletter. This was just this month's. Okay, these come out every single month. The second thing is, this is the type of analysis and education we do at Tackle Trading every single day, throughout the day, more content than you could shake a stick at. Okay, so if you have not yet explored the content and discovered why it is just so fabulous, go check it out. Okay, you can get a free trial. And if you don't like it, no sweat. If you love it, you will, by the way, then all the better. All right, you can join us on the inside and get this type of stuff because it's what we break down each and every day. Okay. All right, with that, I am going to call it a night. I'm sure I'll see you all on another one of these. Appreciate you for taking the time out of your day for joining me, and have an awesome evening. Bye-bye.